Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark says the markets are reflecting Brexit vote jitters. Schachter Asset Management's Josef Schachter gives us 6 reasons why crude is expected to decline. Real estate author Hilliard MacBeth explains the dangers facing Canadian homebuyers. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're speaking with Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Ross, welcome back to This Week in Money.
Thank you very much, Jim.
Ross, a pretty mixed up market as people are anticipating that vote less than a week from now about whether Britain should stay in the European Union.
It was a week with lots of volatility, continuation of what we saw the previous week, where the previous week ended off with this flight to safety. The U.S. dollar was strong, the gold market was strong, the government bonds just rallying, and we had a continuation right through Wednesday, Thursday of this week, and by then things sort of came a little bit unglued in the second half of Thursday, and the gold market had one of those $40 ranges to $13.20 down to $12.80, and then finished off the week just here right around the $1,300 level. But all this anxiety over Brexit and the volatility that's brought into play, a week from now, Brexit will be history. It'll be a binary event. Hopefully they will have a definitive answer, whether they're staying or leaving. But the opportunities will be there for I would suggest for the investors. If we see a leave vote take over, you'd expect to see probably a pretty good pop as far as the flight to safety items are still concerned. So you could easily end up with maybe a 10% move in gold towards the 1430 level. If they vote to stay, you're probably back down into the low 1200s. So it's really what I would consider to be a binary event. It's either off or on from that perspective. And if the vote is for yes to leave, I would suspect that next Friday we'll be looking at some pretty good buying opportunities in some of the North American stocks that have got European, especially British and maybe Irish exposure. There's a lot of the stocks we've been looking at. We can't mention any specific names here, but the good support levels are, I would say, about 10 to 12% below the levels that we've closed at this Friday, and there could be some pretty good opportunities there.
Could there be a real shock to the British job market? Last week they reported record low unemployment. Could those numbers be fixed?
All government numbers can be questioned, and I'm not up to speed in terms of just what the British numbers look like. Clearly, when we see the numbers out of the U.S. and Canada, the adjustments that are done on a month-by-month basis, you really have to take most of the numbers with a grain of salt. But most of what I've seen in terms of the British numbers, clearly there has been a softening in the labor field.
Leading up to the weekend, we had 6 straight days of oil declining, the same thing with the Canadian dollar, but on Friday, things picked up again. Yeah,
a $2 reversal here up on Friday on the oil market. So it had dropped about 10% off the high, 51 down to 46. So first what I would call a decent correction. Now, we are far enough along in this oil move, and when we look at the bad bear markets historically, After a 4 or 5 month recovery, which is what we're at right now, you tend to get some deeper corrections than what we've just seen. So our view here is that this would be the first leg down. You get a bounce, maybe takes us through the next week or so. Then you probably got a deeper correction into the low 40s, maybe 41 to 43 would be a reasonable target, and definitely be looking at that as a buying opportunity as far as the energy stocks are concerned. Now, the Canadian dollar has been moving just hand in hand with the oil, but with a bit more of a negative bias in that in the last few weeks it was not able to take out the April high, whereas the crude oil and most of the other commodities, the grains, the CRB index made that new high. So if oil was to have a second leg here to the downside, the Canadian dollar probably gives up a good 2 or 3 cents at least during that run.
Looking back at gold, I've been told that gold is seasonal. It is softer over the summer months. So even if it does fall or it adjusts a little bit to the English vote, in the fall, prices usually go up anyway. And if the markets take a big dip, like so many people fear, gold will be that safe haven, won't it?
Yeah, that's the typical, that you get that midsummer low as far as gold is concerned, and a few weeks later for the miners. And if the equity market, now if it's just sluggish, then you're not going to see that a strong move into the gold market. But if the equity markets tend to have a little bit more pressure to the downside, a bit more momentum, the bond market, the gold market will get the advantage of that. The typical seasonals for gold would take us, as I say, from midsummer into late September, October, which is where we typically have seen the bottom in terms of the equity market.
Ross, have a great Father's Day.
Thank you very much, Jim. Be with you next week.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Josef Schachter on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
We're chatting with Josef Schachter. He's the president of Schachter Asset Management in Calgary. He's also associated with Maison Placement in Toronto. Welcome back to This Week in Money, Josef.
My pleasure.
Your latest report has kind of a grim short-term prediction for oil prices and stocks, a 30 to 40% decline over the next 4 months. Can you tell us why?
Yeah, we've had a wonderful rally from February from $25 WTI up to $51, and the market, of course, started jumping all over that, and people were thinking, we're now going to have 70 by the end of the winter. But the fundamentals, which were in favor of price recovery, which we were supportive of and we were writing about at the time in the early part of the year, the market's gone way too far, and the fundamentals now are beginning to deteriorate. Firstly, let's go to supply. We had shortages and stoppages, of course, in Canada because of the fires in Fort McMurray, which affected our oil sands production by over 1 million barrels. There was problems with Venezuela because they can't buy diluent. Nigeria had violence problems in the southern or the western part of the country, which halted their exports of quite a bit of crude. And then, of course, Iraq, with the war going on, they were seeing numbers which came down. So all of those were the negatives that helped the price, and supply and demand became in balance, and that was the driving force for the very sharp recovery. We now see 6 reasons why the price of oil will start coming down, and those are all related to a number of different issues. First thing, U.S. production is now rising. People were looking at the $50 price point, that it would take 55 or 60 before you'd start seeing U.S. production rising. But if you look at the data that came out from the EIA this past Wednesday, between the domestic oil production and domestic other supply, which includes natural gas liquids, it grew by 157,000 barrels last week. So it's telling you that the high commodity prices, both for natural gas around 260 and oil, which in the past week was in the 48 to 50 range, and at the end of the week was deteriorating, in the low 46s. That the industry was responding and more production was coming out. There's over 3,600 wells that have been completed that have not been fracked. The game now, of course, is with low frack costs and the prices recovering, you can quickly bring on new production, and that's what we're seeing from the EIA data. Second point is the U.S. rig count has risen for 2 weeks in a row. Last week, the prior week, it rose by 6 rigs, and the prior week by 9. In the week that's ending, Friday, June 17th, we haven't seen the data yet, and so my guess is we'll probably see another increase. The U.S. dollar has begun to lift, which again is contrary to the the pricing of commodities, especially oil. So as the U.S. dollar rallies 2 or 3 cents, that has a negative impact. And again, the Brexit can probably move the U.S. dollar even further to the upside. Fourth point is demand for crude has continued to decline in the United States, in Japan, and in Europe. The only real bright spot has been India. But if the economies around the world are slowing down, even India will start seeing some problems. The fifth point is the bullish consensus, be it in the owning of options or owning of futures, or the bullish percentage index, which is an index that's available on stock charts. When you're bearish and people are scared, you're usually under 10% bulls. When you're bullish and there's excessive enthusiasm, it gets to over 90% bulls. About 2 weeks ago, we were at 94%. We're now backed off into the mid-80s. My guess is sometime as we get this lower price environment that I'm talking about, we will probably see the index go down to single digits again. And then lastly, OPEC production, which everybody thought was going to fall by 500,000 to 750,000 barrels in the month of May. The data came out on Monday of last week. Of this past week, and it showed that the production only fell by just under 100,000. So OPEC's excess capacity now is over 1 million barrels over current demand, and with Canada now coming back, with our production in the thermal and the SAGD and the oil sands, we're going to see our production rally by 500,000 to 1 million over the next 30 to 60 days. This just gets worse and worse with an excess of glut. So we're going to see OPEC production rise. We're going to see Cushing start to rise. We're going to see OPEC production rise. We're going to see inventories rise worldwide. We had a bounce in Cushing inventories this past week when everybody thought Cushing would see a decline. Cushing went up by 900,000 barrels from the EIA report on Wednesday. So all of these things are not watched by the market. They were all looking at the shortages and the outages and all the rest of it. When you put the balance with these other issues in there that have been ignored and are now beginning to be looked at from the data, like the reason a lot of people are talking about the lower oil today is Brexit and U.S. dollar strength. So all of these issues are now going to get more attention, and I think we're going to see the price of oil retreat over the next 3 to 4 months down to the low 30s. So that's been a long dissertation, but the basic issue is that there's a lot of issues that aren't being watched by the market. As they start noting these, the bearish posture will increase.
Joseph, what's your commodity forecast for 2017 and 2018?
I don't have one yet for 2018. Again, that's too far out into the future. Because again, we need to know what's happening with OPEC. We need to know what's happening with the price and how much production there is. We need to know what's going on with the inventory excess. In the OECD, there's over 300 million barrels more than is needed. Just in the United States, crude inventories are 66 million higher than a year ago and 113 million more when you include total stocks. So if inventories start to decline, then you can take a more optimistic view. If they don't decline, then you'd have to take a more cautious view. But I'm using for this year, in terms of my price deck, $43.15 for WTI, so lower than we're trading at currently because of my expectation of another downtick here over the next 3 or 4 months. NYMEX I'm using 260, which is similar to the price we are right now. For 2017, I'm using $55 oil, and what I'm looking for is winter 2016-17 to see stronger prices to cool off in Q2, Q3 of 2017, and then see potentially $60, $70 pricing in Q4 2017 for winter 2017, 2018. And for NYMEX, I'm looking for natural gas prices to firm up in the winter 2016, 2017. Potentially reaching, the high, the high twos. But then in the winter 2017, 2018, I look for $4 to $5 natural gas prices. And so for the whole year, I end up with a $3.60 price for NYMEX in 2017.
In the equity markets, are there any areas you're optimistic about?
Oh, well, the golds are doing really well here. And, I think, if we do see more and more nervousness in the markets and more concern about currencies, more concern about Brexit, more concern about what quantitative easing is doing to destroy, normal rational behavior in the interest rate world. My view is that potentially gold could do much better. My colleague John Ng is looking for much higher prices in 2017 and later in 2016. So, on weakness, if there's windows to where gold corrects, I think that would be a very, very attractive location for investors.
Joseph, thank you very much for being on This Week in Money.
My pleasure.
My guest has been Josef Schachter, president of Schachter Asset Management. He's also associated with Maison Placement in Toronto. Coming up, Hilliard MacBeth, author of the book When the Bubble Bursts, Surviving the Canadian Real Estate Crash, next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
We're speaking with Hilliard MacBeth. He's the author of the book When the Bubble Bursts, Surviving the Canadian Real Estate Crash. He's also a portfolio and financial advisor in Edmonton. Welcome back to This Week in Money, Hilliard.
Nice to be on your show, Jim.
Talk about real estate values, comparing Edmonton and Calgary to Toronto and Vancouver. Vancouver prices up 35% in 1 year. Average prices, you can't believe them, well over $1 million. Now, what's happening in Edmonton and Calgary right now with the downturn in the oil patch? And then we'll get back to that hot market in Toronto and Vancouver.
Well, in Calgary and Edmonton, it's interesting because there is some surprisingly firm activity in some of the price categories in Edmonton and Calgary. So first of all, there's a tremendous overhang of expensive houses in Edmonton, Calgary. So I've written about this in my weekend note. Why don't people sell their house in West Van for $3 million and come to Calgary or Edmonton and buy a nicer house for $1.5 million? But I've learned that people in Vancouver just don't leave Vancouver. So that's probably part of the problem with housing prices in Vancouver. But there are a very, very large number of homes for sale in the really expensive category in Edmonton and Calgary, and I don't see where the buyers are going to come from to take up that inventory. So it's going to be a long, slow process. But in the cheaper categories, and I'm not certain what's causing this, but there are surprisingly some buyers showing up. In fact, there's even a few anecdotes of bidding wars happening at some of the lower price ranges, like $400,000 or $500,000, $300,000. So there's obviously a group of people that are feeling that with the downturn we've had, and the prices have come down. They've come down 10 or 15%. The official numbers show a downturn of only 4 or 5%, but the actual, on the ground numbers are probably a little bit bigger than that, maybe 10 or 15%. People see it as a bargain, and this goes back to all the way back to 2000, I think, in terms of markets and prices, not just in housing, but in the stock market, where people have been conditioned to buy the dips. So whenever there's the 2002 downturn and the 2009 downturn and every other mini downturn in between, people have noticed that if there's a downturn, it always comes back. So therefore, they believe that the thing to do when prices come down is to jump in and get a bargain. And it sort of comes from the kind of the department store mentality where everybody's been conditioned to wait for a sale and jump in. So it's interesting. However, I don't think this period is going to last, because the reality is that the oil and gas expenditures in Alberta and Saskatchewan, which mostly Alberta, dropped from $80 billion a year, billion with a B, to $30 billion a year. So that's $50 billion that's been taken out of the system, and there's a tremendous amount of decline in employment. There's a lot of people that have been asked to work 4 days a week for 80% of their pay, and of course they end up doing 5 days of work. I just talked to a friend of mine yesterday who said that in his division, in the company he works for, pretty well everybody else has been laid off but him, and he's never worked as hard as he's working now for no pay increase, because essentially he's doing all the work of the people that got laid off. So it's extremely stressful, and people so far are very optimistic, and you could almost say perhaps a little bit in denial about the situation, and they're putting a brave face on it. Some people call it whistling past the graveyard, but there's obviously tougher times ahead. And one of the interesting things about banks is that, of course, pretty much all of this house financing and house purchases has to go through some kind of lender, usually a bank. They have been putting out the story that they will help everybody get through this. So, in other words, if you can't make your mortgage payment because you've been laid off, we'll defer the mortgage payments for a couple months. Now, all they do is add that to the value of the mortgage, and you pay a bigger interest charge over the length of the mortgage because of that. But they are willing to make those adjustments. Alberta Treasury Branch is now known as ATB Financial. It's a government agency, and it's also a pretty large bank. Is saying they have a billboard out, which is plastered all over Alberta, that says "We've got your back." So we're in this period, which is kind of in between. And I think in previous cycles it sort of lasted 6 months to a year. This one seems to be lasting a little bit longer than that, where life goes on as normal and people assume that it'll come back. But if there isn't a rebound in the oil and gas activity, then there's going to be a much tougher decisions that need to be made. And I would say probably within the next 6 months. And that means that perhaps buying the dip, as people are doing now, might not be the right thing to do. It might be better to wait for better prices down the road. One of the catalysts, one of the indicators that people could watch for is when some of the spec builders that have got a large amount of inventory on the outskirts of Edmonton and Calgary are forced to liquidate their inventory at a loss. So that would be a sign that we're getting closer to the end of the downturn. But we're still somewhere in the middle of it now. We're not anywhere near the end of it yet.
It can't be very encouraging for Albertans when you have an Ontario government that has a plan to get rid of natural gas.
Yeah, I was surprised that obviously the coal-fired electricity in Ontario is gone, or at least it will be gone soon. I think it might already be gone. The coal-fired electricity in Alberta, which is the last remaining large amount of coal-fired electricity production in Canada, is expected to be phased out over the next several years, according to the Premier and her government in Alberta. But many of us assumed that natural gas would be used to fill the gap. So I was very surprised to see that announcement. I think what that was a leak of a confidential discussion paper, and I'd be very surprised if it actually ever became policy, because natural gas is actually 30% or more less greenhouse gas emissions, and it's a perfect substitute for coal-fired electricity in the interim, because wind and solar and these other possibilities will take longer to fill the gap if they ever can completely fill the gap. I doubt that they'll always have to have natural gas-fired facilities at least on standby. until the grid is more balanced with other factors. Now, obviously, BC and Ontario and Quebec have, and Manitoba have some hydroelectric power that they can use as well. So there are other options, but the natural gas has to play a role in the transition, and that'll probably be a decade or two, I would think. Certainly in Alberta, it will be. The issue had been up until recently was being able to buy the turbines that they used to make the electricity with natural gas, because there were so many people building natural gas facilities all over that there was a shortage of space, and people were facing 2 or 3 year delays to get the equipment to build the natural gas turbines. But I think that has been overcome. General Electric is one of the big producers of the turbine, and I think they've managed to ramp up their production. So, and of course all of this comes from the Paris Accord, which was agreed to in December, and Canada was at the forefront of announcing that we would meet the requirements of the Paris Accord by, I think it's 2020. Is the next time everybody's going to check back. And that holds the makings of a very big confrontation between Alberta and Ontario and the federal government, because Alberta's still increasing the greenhouse gas emissions. Ontario's trying to reduce them. But the amount of reductions that would be required to meet the goal of the Paris Accord overall are very, very substantial. And there would be no coal-fired activity at all in Canada, and the oil sands would probably have to be reduced by a fairly substantial amount as well, although I'm not up on the exact details of that. So, I don't think the leaders want to go back to the meeting 4 years from now and admit that they failed. But on the other hand, I don't think they're aware of how drastic the actions that are needed to be taken, and how politically unpopular they might be in order to actually meet those goals. I guess in politics, 4 years is a long time away, and maybe people just assume by then something else will have happened and it'll all get resolved.
We're speaking with Hilliard MacBeth. He's the author of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard, getting back now to the massive real estate bubbles in Vancouver and Toronto, the Canadian Real Estate Association admits that the prices are just too high. In Vancouver, for example, if prices dropped 18%, 13% of homeowners would be underwater, 4% would be under severe financial stress. If prices dropped 25%, a quarter of homeowners would be underwater. Can you explain what underwater is and just how bad that is?
Well, what's happened, and it hasn't happened in Canada for a long time, but it happened recently in the United States, and this is a situation where people owe more money on their mortgage and maybe their home equity line of credit, called a HELOC, than the house is worth. So when people buy with only 5% down or 10% down or even 20% down, it doesn't take much of a correction in the price of the house to put them underwater, or the other term is upside down on their mortgage. So the reason that lenders don't worry about this very much, at least they haven't until now, is there's a number of reasons, but one of them is that house prices generally have been rising for the last 15 years. So if for some reason the homeowner can't make the payments, and this does happen due to death, divorce, job loss, there's a number of factors, the bank can seize the house and usually can sell it for what the mortgage is worth, or even a little bit more if the house price has risen. But if house prices were to decline even by 5 or 10%, and then you had the situation where there's a divorce or a job loss or something like that, by the time you tack all the fees on, because there's a lot of legal fees involved in just getting control of the asset in order to sell it, the bank is facing a loss of 15, 20%. So what the banks are counting on, and the other lenders are counting on, is there's a human tendency of being very reluctant to default on their mortgage. They'll default on other things like credit cards, but they don't want to lose their house. So they'll actually, even though they're upside down on the mortgage, even though they've got in Vancouver, let's say a house that's worth $800,000, but they've got $1 million mortgage because they bought recently, and then the house price drops by 20%. They might still keep making those mortgage payments on $1 million mortgage if they can, even though the house is only worth $800,000. And really, it doesn't make a lot of sense. They'd be better off just to take the hit. Now, in some jurisdictions, like Alberta, to continue with that example, if somebody's upside down on their mortgage and they walk away, the bank has recourse to seizing the asset and selling the home, but they can't go after the former homeowner for the deficit of $200,000. They can't go and put a garnishee on their wages or anything like that. That's called non-recourse. But really, that only exists in Alberta and possibly in some cases in Saskatchewan, and everywhere else in Canada, including British Columbia and Ontario, there is recourse. So the bank can not only sell the asset, but it also can go after the homeowner for the deficit. So this means that the homeowner can only get out of paying for the loss by declaring personal bankruptcy. So a lot of the people that are providing funding to lend on mortgages for houses, it isn't just the banks. In fact, more and more in Vancouver, I read recently, it's not the banks anymore. It's other lenders, what they call the shadow banking segment. They're not worrying about that because they feel that they can always chase the homeowner down for the deficit. But even before that, they're saying, well, the house prices will always go up, so therefore I won't have to worry. So it's going to be a real shock. And one of the most interesting things in Vancouver, which is happening specifically to Vancouver more than anywhere else, is the amortization periods on the loans are stretching out to 30 and 35 or even 40 years. And the reason that's happening is because people cannot qualify for the mortgages at the normal 25-year amortization. The monthly payments are just too large. So your listeners may have read that the rules have changed and the maximum amortization is 25 years. And that's true if you're going for a CMHC mortgage, or if you want to get a bank mortgage and you don't have 20% down, then you must adhere to the 25-year amortization rule. But if you can put 20% down and you can go to a friendly bank or a credit union, often it's a credit union, you can negotiate a longer amortization period, which lowers your monthly payments. But then the risk is even higher of a downturn. Now the lender would say, well, yeah, but we're getting a 20% down payment. So, a 20% down payment when just a couple of years ago prices were 30 and 40% lower may not be enough to cushion, my prediction is that the prices have to come down 40 or 50%. So even people that are putting 20% down would become upside down on their mortgage and they'd be underwater. And then the big question will loom as to what are the rules on personal bankruptcy and what is the human tendency to decide whether they want to tough it out and keep paying payments on a house that isn't worth anything like what the mortgage is. And it'll be different for every individual person. But the example that we have recently in the United States is very clear. And at one point in the United States, more than 50% of the people under the age of 40 were upside down on their mortgages. And that was after only a 30% downturn in the housing market in most markets. There are a couple of markets like Las Vegas in the United States where prices went down 40% or more, but most markets in the United States, prices sort of corrected about 30% and then they stopped falling. So what happened in the U.S., because they have recourse in some states and they have non-recourse in other states, people tended to keep paying the mortgage payments even though they were upside down on the mortgage because they need a place to live. And also, my personal opinion is that people feel a lot of shame in walking away from a mortgage, and there's a certain amount of pride involved. Even when the financial decision might be correct to just walk away from it, declare personal bankruptcy, and start over again, people are very reluctant to take that step. But unfortunately, in Vancouver, we're going to find out all the answers to all of these questions that we don't know. And it's going to be a very difficult housing correction when it comes.
I know with the last stock market crash in 2009, Vancouver housing prices did drop 15%, but within a year and a half, they were right back to where they were. Perhaps people are expecting the same thing to happen if there's a crash here again.
It's exactly right. This buy the dip mentality, which we see in the stock market, people watched that 2009 crash. The bank stocks in Canada went down 50%. the bank stocks in the United States went down 80%. And based on looking back now with 7 years of history behind us, we can say, the right thing to do is go out and take out the biggest loan you possibly could and buy the bank stocks, even though they were in serious trouble. The government bailed them out, both Canada and the U.S., and people that bought during the crash made out tremendously well. They got a tripling or a quadrupling in their value. Now, most people were too scared to do it, but every time this happens, whether it be 2002 or 2009, the message is reinforced that what you do is you go out and buy when the house prices dip. The problem that is going to happen this time in Canada with housing, which is going to make it impossible for that to happen, is simply this, that the debt levels are much too high. The household debt levels this time around, 15 years later after the 2000 dot-com bubble burst, 16 years now, I guess, the debt levels have tripled, and there just isn't the borrowing capacity available. The rules on lending, the ridiculous situation we're into in Vancouver now, where banks and credit unions are willing to lend 7 times household income, I'm sure that will be changed. I thought it was going to be changed in 2009. I was wrong. I thought when people saw what happened in the United States, they would make those changes. They did make some small changes, like the former finance minister Flaherty reduced the amortization from 40 back to 25 and that, but there were no really big changes in terms of forcing the banks to make sure that people had higher incomes and higher down payments and all that kind of stuff. And Canada's unique in the world in this respect. There's nobody else in the world that puts out the amount of mortgage financing to their citizens with only 5% down, like a CMHC insured mortgage. So now in Vancouver, again, to bring it back to Vancouver, with average prices in $1 million and higher, we're not talking CMHC financing for most of that. The average CMHC loan, CMHC insured loan in BC is $300,000. So I doubt that very many of those people buying those homes in West Van and Kerrisdale and Kitsilano are going to CMHC and getting an insured loan. I suspect that they either have the funds themselves, maybe from foreign sources, or they're going to the shadow banking where the rules are not the same. The rules in the shadow banking thing can be much more lenient, but the interest rates are higher and the down payment requirements are higher as well. So we're going to find out a lot about all of this. But unfortunately, as Warren Buffett says, you only find out who's swimming naked when the tide goes out, and the tide hasn't gone out yet. So we won't find out till the tide does go out.
Of course, housing prices in the interior of BC went up massively as well, and they're pulled up because of the influence of Vancouver, right?
I think so. I was in Invermere recently, the valley south of Golden, I guess it is, and the real estate market there is terrible. But the reason for that is it's almost all Calgary sourced buying in that area, and a lot of the Calgary oil executives have got their homes up for sale. These are vacation homes. Obviously, they're not permanent year-round living homes, and there's just a tremendous amount of, and it's a beautiful valley. But if you go closer to Vancouver, then of course it's a completely different situation, because people in Vancouver, they're either selling their homes in Vancouver and moving to Kelowna or wherever they're moving, so they've got lots of money to spend, or they're using the value of the collateral that they can borrow against in Vancouver to buy a second or third home. So it's definitely related. So the 4 markets in Canada that have gone up the fastest in the last year or so that I've been watching closely are Vancouver and Victoria and Toronto and Hamilton. And obviously the Hamilton-Victoria thing is entirely a function of being the proximity to Toronto and Vancouver. I wouldn't think that Hamilton and Victoria on their own would be that exciting a place to buy a home. There's certainly the jobs aren't that close by, and so it's obviously it's a spillover effect, like you say. So it'll be, but you get back to, we always talk about housing, and all the discussions have been about housing, but really the main problem and the main factor in all of this is the debt. And and we started out talking about being upside down on your mortgage on your house. But, I was talking to a car dealer a couple of days ago in Alberta, and he was telling me about car loans. And it's an even bigger bubble than the housing bubble and the mortgage bubble. And, of course, in Alberta, everybody's got to have the most expensive truck, and at least up until recently anyway. And so the car loans are much bigger in Alberta than they are in BC or Ontario. And they've been getting very creative lately because of the downturn in the oil patch. So if you go and buy a car, now I'm not recommending this. I wouldn't recommend anybody doing this. But apparently the level of creativity has gone through the roof. So now you can consolidate all your other debts into a car loan. Not all of them, I guess, not your house, but your credit cards and other debts into a car loan. And all you have to do is pay 22 or 23% interest. So it's a crazy world out there. Now, that would work for the lender in the instance where that person that's in trouble with their car loan or their truck loan, usually not a car or truck, usually in Alberta, and their credit cards, who maybe has been laid off or isn't getting the overtime that they were getting before, finds a better situation, gets a job, the overtime comes back, and everything's fine. So we're going to find out in a fairly short period of time, a few months, it's not going to last for years, if the lender made a mistake to consolidate those loans at 22%, because the collateral that they're seizing in the form of a truck is not going to be nearly as good as a house. Although I don't expect the house collateral to be that great either in a downturn, but the car collateral is going to be even worse. So lenders are going to take massive losses. In the event that those people can keep paying those payments for a couple, 3 years at 22%, obviously they're going to get their money back and they're going to be fine. But in the event that this thing doesn't come back in 6 months or a year, then there's going to be big trouble. So it isn't just housing; it's also other loans in the system in Canada. And again, it's very shocking and very surprising that Canadians witnessed what happened in the United States with the subprime lending crisis and the resultant consequence of a global financial crisis. But we don't think it'll ever happen here. Canadians are mistakenly believing that there's no subprime lending here. Well, of course there's subprime lending everywhere, especially in Vancouver and Alberta. And that it can't happen to us. Of course it can happen to us. All it takes is a recession where some people lose their jobs and they can't pay back their loan. You were saying a few minutes ago off air about the valuation of housing on a street, and people and you quoted the statistics of 13% of the people would be underwater. And people look at that and say, well, yes, but 87% of the people still are fine. And in fact, if you imagine a house on a street, and say there's 10 houses on the street, and 9 of them have no mortgage at all, and there's one house with a huge mortgage on it with only 5% down, and then the house prices all go down 20%, and that 10th house that has the big mortgage gets foreclosed on, it gets sold, and obviously the price wouldn't be very good because it would be a foreclosure, and the price might be down 25% on that one house. Well, all the other houses on the street now are worth 25% less. They don't deserve to be. None of them took out a big mortgage. None of them are in trouble. Every single one of them are in great shape. But the way house valuations work is all of the houses on that street, all 10 of them go down by 25%, assuming the houses are all similar quality. So it doesn't take more than 10 or 13% of the houses to be underwater on their mortgage. Exactly what happened in the U.S. Subprime lending was never more than 10% of the total lending in the U.S., but it dragged down all the other values of all the other real estate. And this is a nuance that has escaped most people. I don't think they realize that because really only 5% of the houses in the whole market turn over in any 1 year, all it takes is for the 5% that are trading, whether maybe some of them are bank foreclosures and they get sold at a discount or something, it can drag down the whole average. The same way that a few houses in West Van are dragging up the average in Vancouver today, the same thing can happen on the opposite, on the downside as well.
Hilliard, how can people get a hold of your book when the bubble burst, Surviving the Canadian Real Estate Crash?
Well, they can go to Amazon Amazon.ca, Amazon.com. They can go to chapters, any of the bookstores, Indigo, that sort of thing. If they search my name, Hilliard MacBeth, all kinds of interviews and information will come up, including my website. So it's very easy to find. And I've been told by many people that it's very easy to read, even though it's on a fairly serious topic. There's lots of information, especially in part 3 about surviving the crash, because that's, I think, of more interest maybe today than when the book first came out a little bit more than a year ago. It seems the change now is that people realize we're in a bubble. So now the question is, how do you survive the inevitable correction when the bubble bursts? And that's a big chunk of the book. So I'd encourage people to have a look at that.
Hilliard, thank you very much for being on This Week in Money.
Thanks very much, Jim.
My guest has been Hilliard MacBeth, Edmonton Portfolio Manager and Financial Advisor. And of course, the author of the book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash. That wraps up our show for this week. Thanks to our guests, Ross Clark, Josef Schachter, and Hilliard MacBeth. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.